All right, y'all. Appreciate you being here as always. Principles one still, believe it or not. Hey, you know what? It's cool though. We're already halfway through the semester. I just realized that. You know how fast time goes. So, it cruises by. It really does. And so, just wanted to really quickly point out where we are, what we have to do for Sunday. So scrolling down in the classroom, we are already in week 8. So halfway through the semester. So there's two action items for you to complete by Sunday night. One is going to be the quiz for chapter 8, which is going to be covered in our discussion this evening. And also we have the midterm exam. So both the midterm exam and the chapter 8 quiz are both due on Sunday night. Now, here's what I'm going to do for you because I care a lot about you and I care a lot about your success, especially in this class, right? So, my promise to you is that I'm going to not only post the recording to this discussion tonight, but I'm also going to post a second recording that reviews the midterm exam. And so it will provide you with tips and tricks to be very, very successful in that midterm exam. So stand by for that. I should hopefully have those both posted to the classroom tonight, at the very latest tomorrow. But definitely as soon as I possibly can, so that way you can take that Chapter 8 quiz and that midterm exam and be successful at both of them. All right, so that's where we are. That's where we're heading. And then next week you don't have any classes because it's spring break. So you'll be able to enjoy a nice reprieve from having to do much for school next week. So okay, let's go ahead and jump into our discussion on cash fraud and internal control. This is a really fun conversation. I'm going to talk to you at length about this, and I'm going to tell you some really cool stories that happened to me. And for those of you who are in hospitality, you're going to totally get this because the examples I'm going to give are from the hotel business. Or if you've worked in retail before, you'll also get this because both of those types of businesses do a lot with cash, but we also understand that in hospitality and in retail, we have a lot of different types of employees and customers that work with us. So I think you're going to really find this chapter interesting and these topics really interesting. I'm going to give you some tips as managers to be able to be really effective when it comes to your cash, especially for the business owners in the room, like Chef Kevin. I know that managing your cash in your business is really important. So I want to make sure that we are very clear on this as well. So let's go ahead and jump into this conversation. I want to first start by talking about internal control systems. Now, one of the biggest things in management is to safeguard your assets. It's really, really important as a manager or as an owner of a small business that you are ensuring that your operation is successful. And one of the ways that we do that is by safeguarding our assets and making sure that our cash is properly maintained. Now, the way that we safeguard our assets and by protecting our business is through establishing what we call a system of internal controls. Now, management will use these internal systems of controls to help monitor and control our business activities. We've got to make sure that we're protecting our assets at all costs, right? Because without our assets, we cannot run the business. Without cash, I can't run the business. Without inventory, can't run the business. Without property, plant, and equipment, I can't run the business. So I need to really protect my assets at all costs. Now, the way that I protect those assets might include things like security cameras, lock and key, separation of duties and responsibilities among employees. These are all methods that I employ to protect the assets of the business. And as a small business owner or as a manager, you want to be able to implement these systems of internal controls to protect the company. The systems of internal controls also helps us to ensure that our accounting system is reliable. Now, reliability simply means that I can audit my system and I know it's going to be accurate. I know that the entries that I made are accurate. And so that's what it means for it to be reliable, is that it's accurate. I can rely on that system to be true and accurate. Now, as a manager or even as a small business owner, you want to make sure that your company has policies. These company policies are designed to protect you as an employee, as a manager, or as a business owner. Now, company policies can be created not only just for the employees of the company, but also for the customers and also for your vendors and also for anyone outside the company. Okay. Having these set of policies is really critical. And I'm looking at you, Chef Kevin, because I know that your business is really risky. Okay. Then that's just the nature of your type of work. It's, God forbid somebody gets sick or whatever the case might be. But having a good set of policies and procedures in place will protect you in the long run. So, God forbid you get sued by a customer for whatever reason. Well, if your company got policies in place and it turns out that that customer violated one of those policies, you're protected. Okay. So make sure that, regardless of whether you're a manager or a small business owner, your company got good policies. You want to uphold all of those policies. The last part about having good system of internal controls is to be efficient with your business. You want to promote efficient operations of your business. Now, what this does is it limits any type of slack, any type of waste, and it also makes you look like an operations rock star. Okay, that you're doing everything right by the company. Now, you do all these things, your business is going to have a great system of internal controls. Now, why are all these internal control systems so important? Well, 25 years ago, yeah, at least 25 years ago, 25 years ago, and I'm looking at the clock, 25 years ago, there was a situation with a very large publicly traded company that you might have heard about in maybe your one of your management classes, or maybe you remember this. There's this company called Enron back in the late 90s, early 2000s. And this company had a huge fraud situation going on with them that was orchestrated inside the company. Now, what happened was uh, they created a bunch of fake invoices that made it look like the company had sales that really didn't exist. And so they would create these fake sales. It would increase the stock price of the company because it made it look like they were being really successful. And then somebody would go and void those transactions out in their system. Well, that's fraud. And the fraud that was perpetrated wasn't just, um, to make themselves look good. It was to attract new investors. And that's wrong. I mean, you really shouldn't be doing that kind of stuff to attract new investors because you're building those investments off of something that didn't even happen. So, because of that situation with Enron and a few other companies like um, HealthSouth, Enron, WorldCom, there was a there's a few other bigger ones. There was a one recently that maybe you heard about in the news, maybe last year, Theranos. There was another one that committed this type of fraud. And because of those large cases, the federal government and Congress created what we call the Sarbanes-Oxley Act of 2002, and this requires companies to be that are publicly traded to be independently audited and to ensure that those companies have a solid system of internal controls to prevent any type of fraudulent situation from happening again in the future. Now, this required companies that are publicly traded to have efficient internal control systems, be independently audited and verified, uh, and to establish penalties to those that violate these new regulations. Now, back in the case of Enron, that case involved a murder, a suicide, and a bunch of people that went to prison for a real long time. So if you ever get a chance to look that case up, there's a couple of great documentaries on the case of Enron that I would recommend that you watch. Uh, 45 minutes, but it's worth it. I promise you. You'll be very intrigued by the case because it's created this huge law that now all publicly companies are required to follow. So just really interesting stuff. Now, the internal control systems that companies develop are built on this list of five guidelines. And these guidelines were created by the Committee of Sponsoring Organizations, also known as COSO. This is another government body. And the five requirements that they've established are controlling the environment, which is where the company structures, ethics, and integrity are established for internal controls. There's a risk assessment, which is where the company identifies, analyzes, and manages risk factors. There's control activities, which are built on policies and procedures to reduce risk of loss. There's information and communication, which are reports to internal and external parties, and these also include the financial statements, income statement, balance sheet, statement of cash flows, and statement of retained earnings. And then there's monitoring. It's important for the company to continuously review the adequacy of those internal control processes and procedures. So the COSO helped to establish these guidelines in order to help small businesses and publicly traded companies to establish systems of good quality internal control systems. For internal controls, they vary from company to company. There's no set standard, there's no set policy requirement other than the fact that the public companies have to have it. Other than that, there's no playbook, if you will, for internal controls that every company follows. So this is going to vary from company to company. But I will tell you that every good system of internal controls does these seven things and does them pretty well. The first is establishing responsibilities. We want to make sure that uh, every employee knows what they're supposed to be doing based off their responsibilities. Everyone's accountable for their actions, and everyone's acting ethically. So that's the first one. The second one is that the business must maintain adequate records. So that's why I always promote my small business owners in the class that you should really consider using something like QuickBooks or some type of um, accounting system to maintain your records because this maintains the integrity of the business. Okay, so it's maintain adequate records, super important, especially in an audit situation from the IRS. Number three, ensure the assets and key employees You want to bond them. Okay, here's what this means. Insuring your assets. Have insurance policies on your assets. An umbrella insurance policy should do the trick. But you also want to make sure that you safeguard your assets under lock and key, under security camera, etc. And bonding key employees, here's what this means. Back when I was in retail, as a manager, they gave me a key to the store. Okay. As a key holder, I had access to all the inventory. Okay. The company wanted to insure themselves with and against me. What I mean by that is that when you bond a key holding employee, you're insuring that employee. In the event that something happens with that employee, or that employee goes and takes everything you got, you're bonded. So it's a legally binding contract, and it's also an insurance policy. That's what bonding key employee means. Number 4, separate record keeping from the custody of assets. The person entering the transactions into the accounting information system should not be the same person receiving the inventory, and probably should not be the same person receiving the cash and bringing it to the bank. Why? Because if it were all the same person or same people, the problem is they could collude with others, or they could, put a little bit in their pocket and then record something a little bit less, and nobody's going to know the difference. So that's why you want to keep the records separate from the assets. And that's kind of related to number 5 here, dividing responsibility for related transactions. The same employee receiving the cash should not be the same employee entering that transaction into the accounting system. Yeah, you want to make sure that you keep those separate as much as possible. Number 6, use technology wherever you can. That's why I promote things like small business owners using QuickBooks or some other accounting software. Why? Because it's going to save you a lot of time, a lot of headache, and it's going to ensure that your records are more accurate. And then number 7, perform regular independent reviews. Look at your stuff, count your inventory at least once a year. Make sure that what you say is true in your accounting record is actually true and accurate. So do those 7 things, do them well, and you'll have a great system of internal controls. All right. So let's roll through each one in a little bit more detail. That first one we talked about was establishing responsibilities. Responsibilities for tasks should be very clearly established and assigned. And that should be typically done by management. When a problem arises, you want there to be a set policy in place in order to find who was at fault during that situation. Companies just typically establish these types of responsibilities with a separate account and password for each employee to access the accounting information system, but also who's clocking in and out, right? These days, we use fingerprint readers actually to clock in and out for our employees. Why? Because you can't fake a fingerprint, right? So, because back in the day, I'd be running late and I'd call my buddy up and say, "Hey, I'm running late." And he'd go, "Okay, what's your 4-digit number?" And go to the time clock and punch me in, right? No, can't do that no more. So, yeah, got to keep everything separated. And this helps us to be more accountable, and responsible. Maintain adequate records. You want to protect assets and help your managers to identify and monitor company activities. Having a good set of records helps to safeguard the company. Okay. Absolutely. This includes things like detailed records, using the chart of accounts, which are all the accounts that we use in accounting for your company. Use pre-printed forms that are also known as pre-numbered. For those of you who are doing invoices, every invoice should have a unique number. Every salesperson should have a unique number. Everything should be separated, so that way we can trace things. Yeah, you want pre-numbered sales slips or invoices. You want a computerized accounting information system or point of sale, so that way we can track everything that goes in. And you should always make sure you back everything up to the cloud. Please don't leave something on your hard drive. Please don't do that. Something happened to your computer, you're in trouble. All right, so maintain adequate records. Next one, insure the assets and bond your key employees. Get yourself an umbrella policy for insurance. Why? Because it protects you against a lot of different things. You want to make sure that you're safeguarding your assets by insuring them, right? Because it insures it against loss, right? If there's a fire, if there's theft, damage, you name it, you want to make sure that your inventory and your assets are insured for those very reasons. Insure against loss. The employees are handling cash and other assets. We should bond those employees. A bond is a legally binding contract agreement and a form of insurance with those employees. So, in the event that something happens with those employees, you're insured. Okay, it insures against theft from that employee. It insures the company and safeguards the assets. That's what a bond does for us. Next up, separate record keeping from the custody of assets. Person who controls the or has access to the assets must not also have access to the accounting information system. We do not want the same person handling cash to be entering cash transactions in the accounting information system. Why? Because it opens up the door for a risk of that employee taking some of that cash and putting it in their pocket and then entering a lesser amount. So that's why we want to keep those types of duties separated from each other. We also want to make sure that we have more than one employee in the room that's counting cash. The reason for that, again, we want to make sure we're protecting the asset, in this case, the cash, and the employees. I'll give you an example of this. A long time ago at Sears, I was working at Sears, and the store had a cash room. Think about high volume sales. There's a lot of cash that comes into retail, and oftentimes there was a cash room or a safe room, if you will, where all the cash was kept. And so at the end of the night, there'd usually be at least two managers on duty that would go into that cash room and count the cash, from the cash registers. And they'd verify, write everything down, put it in the safe, or bring it to the bank. And that would be the process. So having more than one person counting that cash at the same time, really, really important. Next up, you want to divide the responsibility for related transactions. Responsibility for the transaction should be divided between two or more people or individuals in separate departments. What this does is it helps to ensure that the work of one person is acting as a check and balance against the other. Okay, so it really is a way to separate duties and to ensure that everyone's acting ethically and responsibly together. Next up, technology. You want to apply as much technology in your business as possible. Cash registers, time clocks, ID scanners, fingerprint readers, retina scanners. All of these things help us to really provide a sense of security for the business. Your business should also be operating on a virtual private network. You don't want your computer for your business to be accessing a public network at a coffee shop. Why? Because somebody might hack that system and all of a sudden they have all your company's information, downloads all that information, and then goes commit some kind of fraud. So be really, really careful with the wireless networks you're connecting to. And obviously, and this should be hopefully true for your UDC account, make sure you have two-factor authentication. Okay. Uh, because you don't want somebody hacking that email address because they might do something silly and all of a sudden you're in trouble for that reason. So just be super, super careful. Same with your phones. Make sure that you've got a password on your phone or a fingerprint reader or whatever. Protect yourself, please. Super, super important. Perform regular independent audits and reviews of your systems. Make sure that all the information you've entered is correct. Make sure that everything's on the up and up, and that if there is ever an audit situation, that you can attest that everything is as it's supposed to be. So do independent reviews yourself. Go through, count your inventory, make sure everything's there, make sure that your accounting information system is accurate, all that good stuff. Very, very important. The principles of internal control are super important regardless of the type of company that you're in, that regardless of the size of the company that you have, and regardless of the technology that you have. I've seen everything from being completely manual operation to completely automated. And I'll tell you that, yeah, technology makes everything quick and easy and helps managers to use their time wisely. But you have to really understand the technology. It's really important for sure because that tells you what you should be looking for. Technology helps us to reduce processing errors, but definitely because I can take a picture of that receipt, upload it to my accounting information system, everything's accordingly tracked, and it reduces the risk of me accidentally putting an extra zero in, which I've been known to do, by the way. It is more extensive testing of records, the technology. It allows the accounting records that are kept manually to be checked regularly for accuracy. And that's what we mean by testing of records. New evidence of processing. Technology makes it possible to record additional transaction details not possible with our manual systems that we had to use before. So taking a picture of that receipt and uploading it to your QuickBooks, it creates a timestamp, tells you who did it, all that stuff is there for you. So it provides a great significant amount of evidence of the process. Separation of duties. Company with a couple of employees is always at risk of losing its separation of duties. If it's just one person, if Kevin's by himself and that's, you know, running the whole operation, it can be difficult to separate duties, obviously, if it's just you. But you want to establish some type of policy, something to safeguard, so that way when you do bring employees in, that everything's separated out in the way that it's supposed to be. Increased e-commerce like Amazon and eBay. We do a lot of transactions these days over the internet for sure. The problem is that it opens up a couple of areas of risk. One is credit card theft. Once a customer enters that number online somewhere, there's a risk. There's a risk that data could be compromised. Computer viruses, yeah, no kidding. I've seen plenty of that, or even worse, impersonation or identity theft can also occur. So if you're accepting credit cards in your business or any type of customer details, you want to make sure that all of that is very, very safe, and that you're not storing that type of information somewhere that's not secure because it can really open you up to a whole mess of problems. So be super careful, especially when it comes to customer information and credit cards. Related to that technology is something that's a little bit newer that you may have heard about already. It's been around for probably the past 15 years or so. It's called blockchain. Blockchain is a really secure type of accounting ledger. What this does is everything is continuously and simultaneously updated and verified in a way that is extremely secure. And it cannot be modified. The information cannot be modified at all without a really significant detailed record of changes. Now, what that means is that the accounting record can never be destroyed. It can never be maliciously affected, and it can't be hidden. So that's what blockchain does for us, and that's why I wanted to bring that up. This is being used a lot now in accounting and consulting firms. Uh, it's it's a really good technology to have because it makes all of your transactions extremely secure. Now, one of the drawbacks, obviously, with any type of internal control system is the human element. Man, I can't tell you how many times I've accidentally entered an extra zero in or entered a incorrect credit card number in. I make mistakes. And I think a lot of people do. It's just human error. We are not perfect. Sometimes we could be a little bit careless, maybe. Sometimes I might misjudge a situation, or even worse, and this happens to me a lot. I get confused sometimes. I think I told you the story with Cisco when I was at the hotel. I was late at night entering Cisco bills into my accounting information system. It was late Friday night. And I have an inbox and an outbox on my desk. And so I went to the inbox and I started entering the transactions into my accounting information system from the Cisco bill that just so happened to be, in the tens of thousands of dollars. And so I enter everything in, I post it, and usually what I do is I'll stamp it, sign it, and put it in my outbox. So that way I know I did it. But for some reason this night I got confused because it was late at night and I was tired. So I put that right back in my inbox. Now, when I came back on Monday morning, the first thing I did was I entered all the bills in my inbox. Kind of forgot about that one that I did on Friday. So I entered it again. That's human error. I was confused. Didn't mean to do that. It happens. The other risk that we have with internal control systems is human fraud. This is the intentional defeating of an internal control system, such as a management override. Okay, I've seen that. I've seen a lot of that. Oh, management override. The worst thing I used to see a lot in the hotel, especially at the bar in the restaurant, is hitting that no sale button on the register. Okay, don't do that. That is not good. Okay. Even if you're making change for a customer, don't hit the no sale. Now, if you need change, get it from somebody outside the register. Don't be hitting that no sale button. All right. Don't lock and key and open that register drawer. So I'm telling you, it don't look good. All right. Even if you don't have bad intent, it ain't good to open up that register drawer by unlocking it or hitting no sale. Okay, just be super careful with this. I promise you, you get in a lot of trouble. I used to see bartenders. They'll ring up a drink, they'll take the cash from the customer. If it's exact cash, I've seen them go hit no sale, clear that transaction out, put the money in their pocket. That's theft and fraud. Okay, you go to jail for that. So don't be doing that kind of thing. In order for fraud to happen, there must be three things: an opportunity to commit the fraud, a pressure to commit the fraud, and a rationalization to commit the fraud. The opportunity is there's a weakness in the business where, hey, I could just open up that cash register drawer, ain't nobody going to see it. That's opportunity. The pressure is financial pressure at home. Oh, got bills to pay. Family stress, society stress. That's pressure. And then rationalization. Oh, everyone does it, right? Those three things need to exist for fraud to occur. So you want to limit those three things as much as possible. Okay. And the other thing you need to know is that when you implement an internal control system, you have to look at your cost benefit analysis. The cost benefit analysis is that the benefit of implementing your internal control system must always outweigh the cost of implementing it. You must consider all factors, and you must consider the fact that the benefit needs to outweigh the cost before you decide to implement an internal control system. So that's my discussion on internal controls. Now I want to switch and I want to talk about cash. Cash is king. Cash rules everything around me. So let's talk about cash and why cash is king. Now, it's so important to control your cash, right? I always know how much cash I got on me. I always know. I always know how much cash is in my drawer. I always know how much cash is in my bank. You got to know where your cash is and where your cash is at all times. Now, how do you do that? You have a good system of internal controls that protects your cash and your cash equivalents. And your internal controls needs to have these three guidelines. One, handling cash is separated from the person recording the cash. Okay, keep those things separate. Number two, cash receipts are promptly deposited in the bank. Don't let them just sit there on your desk. Okay, that'd be silly. And number three, cash payments are made by check or EFT, electronic funds transfer. Cash, check, money order, or some type of transfer. Okay, bank to bank. These are great guidelines for handling cash. Now, you heard me mention this word called cash equivalents, and cash and cash equivalents, and we'll talk about liquidity. Liquidity refers to the company's ability to quickly convert their assets into cash. That makes your assets liquid. This also refers to the company's ability to pay for its current liabilities. We use cash and liquid assets to pay for those liabilities. That's what liquidity means. Cash refers to physical paper currency, coins, deposits in bank accounts, checks, cashier's checks, certified checks, money orders. I would also include digital currency in this area, like Bitcoin. That's all cash. All we treat it all the same way as cash. Cash equivalents are short-term, highly liquid investments. They typically include things like stocks and treasury bonds, also known as T-bills. These are short-term investments that could quickly liquidate and convert into cash. Stocks, I can sell those overnight. Treasury bills, I can sell those overnight. So whatever I can quickly convert into cash, we call those cash equivalents. What we do not consider as a cash equivalent is inventory. The reason why we don't include inventory as a quick asset is because it takes a long time to sell inventory, even if you try to liquidate it. It takes a long time. So we do not include inventory when we talk about cash equivalents. Right? Now, when you're managing cash, you want to be super, super careful. All right. You want to, because cash is king, cash rules everything around me. As a good manager, as a good operator, as a good business owner, you want to understand when cash is coming in from your customers and understand when you need to pay your bills. Okay? That will help you to establish what we call a cash budget. That cash budget is going to help you when it comes to planning your business's operations and ensuring that you always have enough cash on hand. Now, you need to make sure that you have enough cash on hand at all times to continue your operations. Rule of thumb is you want to have a separate bank account to pay your employees out of that's separated from the account that you pay your bills out of. Okay, that is absolutely critical. Okay, because you need to make sure that you make payroll every single week or every 2 weeks, whatever it is, and you have to make sure that you have enough cash on hand to pay your bills. All right, so super super important that you manage your cash effectively. All right, now there's a couple of other things I should tell you about here. Um, I'm not saying I've done this, but although I have, I told you about my uncle's filing system. I think I did. I think I told you about the way that he pays his bills. He gets his bills from the mail and he puts them into three different piles. And one time I asked him, I said, Uncle, why you separate three piles for your bills? He said, well, I have a filing system. I said, what's that? He says, this one is marked as pay, so I'm going to pay those right away. The other one says delay, so I'm going to put them off for a bit. And the last one is throw away, because they'll send another bill later. It's not a good system to use, but I'm just telling you what he did. The reason why I bring that up is because you see delay payment of liabilities on this slide. Now, sometimes you might not have enough cash on hand to, and you need to prioritize your bills. So sometimes it might be okay to slow pay. Yeah, slow walk them. It's all right. Just don't let it hit your credit. But it's okay to wait a few days. Keep only necessary assets on hand. This is what caused Bed Bath and Beyond to go out of business, is that they tied up all of their cash into having too much inventory. That killed that company. Okay? That's what put them under ultimately. So you want to make sure you keep only necessary assets on hand. Make sure you have enough cash to cover any potential shortages. And the way to do that is make sure that you don't have too much inventory. All right. All right. Plan for your expenses. Have a budget. Understand what that budget, understand when the cash is coming in, understand when it goes out. Plan for your expenses. And then lastly, if you have extra cash on hand, invest it. All right. Invest it into property, plant, and equipment. Expand your business if you have excess cash. You could also put it into short-term investments to earn some interest too. All right. Let's talk more about cash and when we receive it from our customers. Customers pay us in one of two ways. They'll pay you over the counter or they'll pay you through accounts receivable. When they're paying you over the counter, it's real simple. We're just going to debit the cash and credit the sale. If they're going to pay you accounts receivable, we debit accounts receivable, credit the sale. Then, when the customer pays us, we debit cash and credit their account receivable. Either way, the company's receiving cash at some point. Now, whenever you receive it, you want to make sure that you got two different people. The clerk, the person receiving the cash, should not be the same person that's entering the record. All right, you want to keep those two separated. Right? This slide gives us a nice snapshot of how that works. So the clerk receiving the cash, they're going to fill out the deposit slip, how much cash they've received. They're going to put that deposit slip in with the cash, and they're going to bring it to the bank. The bank's going to provide them with a receipt. That receipt is going to go to the person who's entering the records into the accounting system. That is how we keep a separate record. All right. Now let me tell you about the over under. I know. I can already hear some of you retail people out there because this happened to me before too, so don't think you're alone. Now, sometimes you might accidentally forget to give some change out. Whoops. That's happened. Hey, when it gets busy, that's happened to me before. Come on. Or a couple bills get stuck together. You know how it goes. All right, sometimes we make mistakes and we shortchange a customer. Okay, it happens. We don't want to do that, but it does happen. We still have to record that difference in accounting. So here we have an example. Cash register showed that we made $550 in sales. When we counted the drawer at the end of the night, it showed $555 in cash. Okay, that's obviously a discrepancy, a difference. That means that we accidentally did not give $5 back to a customer. So we still need to record the fact that we have that extra $5 in cash. So we're going to debit cash, $555, because that's how much cash is in the bank. We're going to credit sales, $550, because that's how many sales we actually made. Then we're going to credit this account called cash over and short. As the name implies, it's what's over and short. So in this case, $5. That's how we record it. Now, the other thing might get you fired. This one might get you fired. Okay. Be careful. Be careful when you operate in that register. Make sure you're exacting your change. Shortage. Oh boy. I've seen this plenty of times in retail. Now, here's the thing. Sometimes we give out too much change. Whoops. All right. So, end of the night, we print the Z tape from the register. It shows that we made $625 in sales. We open that register up, we count the cash. The cash amount came to $621. That means we're $4 short. So I need to make an adjusting entry. I debit cash, $621. I debit cash over and short, $4. Then I'm going to credit my sales, $625. Yeah, it happens. But like I said, don't get fired over this. Make sure that you're giving out the right change. Seen it happen too many times. All right. And golly, I don't know who y'all are, but don't put no cash in the mail. I know you like to send your grandkids some cash in that birthday card. Don't do that. That's silly. Send them a gift card. Okay? Don't be sending them no cash in the mail. That's dangerous. I know them postal service people, they know what's up. So don't be sending no cash in the mail, okay? Just don't do that. All right, when you pay your bills, don't put no cash in the mail either. I want to see a check. I want to see a cashier's check or some type of paper rather than actual cash. That's dangerous. Right. So, back in the hotel business, uh, we receive a lot of mail every day, and we have customers paying their accounts or guests paying their accounts, and so we would assign two people to take care of the mail. So we would receive checks in the mail, and those checks were separated from whoever else was receiving the mail, and we would record what was being received, who was received from. The checks would go into a safety deposit box along with the slip. Copy of the slip went up to the accounting office, and the accounting office would record it into the system. That's how we keep it all separated. You have to control your cash, whether it's being received from you or you're receiving it or you're paying it. Either way, it has to be controlled. Oh man, this one. Controlling cash payments is super critical to prevent theft that occurs from the payment of fake invoices. This has been happening recently in the Baltimore area. People have been receiving text messages now saying that they have toll violations, and it's coming from Baltimore City Court. And it's fascinating, right? Listen, if you ever get a text message like that, ignore that. It ain't real, okay? But people don't know that. So some people be paying it. Don't pay that. You have to be careful to make sure that that invoice is real, that it actually happened. Now, a way to do that is to verify that invoice, match it to your other records to make sure that that actually did happen. Now, how do we control it? Require all payments to be made by check, limit access to the accounting information system except for those who have the ability to sign checks, and within your cash budget, make sure that you're identifying when cash is supposed to be received from customers and when it's supposed to be paid out. Do those things, you'll be okay. Just make sure you protect yourself, okay? Now, I would always do this process for every bill I have and for every payment I ever make, even for payments I receive from my customers or my clients. It's called a voucher system. Voucher system set of process procedures and approvals designed to safeguard your cash. It includes things like verifying, approving, and recording liabilities for cash payments and issuing checks for payment of verified, approved, and recorded liabilities in your accounting system. You want to make sure what's actually in there. Now, here's what it looks like. And I would do this with every single bill that the hotel had. And because it creates a record. That's what a voucher system does. It creates a really solid record. I would do things like I would match the purchase order to the packing slip to the invoice, to the receiving report, to the invoice approval, which means we're approving paying it, and a copy of the check. I'd staple all them together, bring that check over to the people signing it, which was the general manager and the treasurer, and then I would send that check out. But not before I did all this. Now, why I did all that? Because you want to verify that what you're paying is true and accurate. Don't be wasting money now. Protect your money. Make sure what you're paying is true and accurate. Have a system, have a record, have a paper trail. In larger companies like the hotel business, we typically have what we call enterprise resource planning systems. Now, for those of you in hospitality, you may have used Opera or some type of software that we use in the hospitality business. That software, like a point of sale system, is all connected to what we call an enterprise resource planning system. It's a all-in-one type of system that includes your human resources, payroll, accounting, and operations all in one place. And what this does is it helps to secure your system. It streamlines electronic and cash receipts and payments, automates accounting processes and procedures, facilitates electronic cash payments, facilitates electronic payments, and helps us to create invoices that match to the purchase order and requisition and receiving receipt for verification purposes. So, in other words, this is an electronic version of that voucher system that I showed you earlier. And that's what an ERP does for us, electronic enterprise resource planning system. The next thing of cash I want to talk to you about is called petty cash. Now, small business owners, you know what this is, or you should know what this is. And if you've worked at the front desk of a hotel, you know what this is. If you work for a small business that has small bills, you know what this is. We call this petty cash. Petty cash is used for small payments for things like shipping fees, small repairs, low-cost supplies, stamps, front desk supplies, that type of stuff. Just real small stuff where you're like, I can't go bother the accounting office for $5 for me to go run down and get some stamps at the post office. I can't be bothering accounting office to pay the flower lady who takes care of the lobby. Okay? No. We have petty cash fund at the front desk for that. And when you use that cash, make sure you get a receipt and the change. You put the change in the receipt back in the box. That way, at the end of the month, accounting office will replenish the petty cash fund. I'm going to show you how to create the petty cash fund and how to replenish it. So, to establish a petty cash fund, it's very easy. All you do is you debit petty cash and credit cash. What this does is it creates a new petty cash account. Here I have an example, the corner store. Corner store created a petty cash fund for $75 with the expectation that the corner store needs to pay for small, insignificant things, and then they'll replenish that fund later on. So that's really what this does. So $75. Debit petty cash, 75. Credit cash, 75. This creates the new petty cash fund. Now, throughout the month, the store incurred some minor expenses and used petty cash for it. Because why not, right? It's there, so use it. It's small amounts of cash. And so the way that it worked was on November 5, 15, 18, and 27, small expenses were incurred. And we got receipts for everything. and we put those back into the cash box where the petty cash fund is. $15 for parking, $4 for printing, $5 for postage, $47 for the janitor come clean the store. Okay? Simple. So we got all our receipts, put them in the cash box. Now at the end of the month, I need to replenish my petty cash fund. Before I do that, I need to recognize that all those expenses have happened. So I need to make an adjusting journal entry at the end of the month. I'm going to debit parking expense 15, debit printing expense 4, debit postage expense 5, debit janitorial expense or repairs and maintenance 47. I'm going to credit cash $71 because I used that cash. Then I'm going to replenish the cash in the petty cash fund. What I would normally do is debit petty cash $71, which I think is how much they used, and credit the cash $71. That would replenish the cash fund. If you want to increase the petty cash fund, it's very simple. You just debit petty cash, credit cash. If you want to decrease that petty cash fund and return it back to cash, very simple. You just debit cash, credit the petty cash. Easy peasy. Now, if the petty cash fund just so happens to be over or short because somebody forgot to get the receipt and put it in the box, because we forgot the receipt, forgot to put it in the box, that means that we short on our petty cash fund. So they need to make an adjusting entry. They're going to debit all the expenses, debit over under, and credit the cash. It happens, but man, don't let it happen too much. All right. Couple things you should know that banks do with respect to cash. They're going to provide you with a signature card, also known as a stamp, with your signature on it, if you have a lot of checks that you need to sign. You can get deposit tickets. Deposit ticket is real simple. You just fill it out, put it in the slip in the bag, and then when you bring it to the bank, the bank knows what they're receiving. Bank statements, they give you one of them typically at the end of every month or beginning of the following month. Shows you what happened with your bank account during the month. Checks that cleared, checks that didn't clear, that type of stuff. EFT, that's just they give you a routing number and checking account number. You give that routing and checking account number when you pay your bills online, or you give it to your customers when they're going to pay you. Call that electronic funds transfer. Checks, those are just paper checks. Okay. And then obviously they can create any type of bank account that you need. Those are all things that banks provide. This is an example of a deposit ticket, deposit slip. It's used to deposit money to the bank. You write down the amount of physical currency and coins. You get your total. On the other side, you list out the checks you received from your customers, check number and amount, add them all up, add that to your cash amount, and that gives you your net deposit. That's how a deposit ticket works. Very easy. It serves as proof of the deposit. I typically make copies of that just for your own records. This is a thing called a check. Some of my younger students in the room might not know what this is. You may not have seen a paper check before. Hopefully you have. All right, this is a paper check. Paper check got who's making the check, who's being paid, who the check being paid to, the amount, the bank the check is coming from, a memo line, and a signature On the bottom of the check, you might have an area that you tear off called a remittance. Remittance is just uh, the stub, tells you what the check is for. Yeah. If you received a pay check, a physical pay stub from work, the very bottom is what it was all for. Yeah. I'm sure a lot of you do this. Electronic funds transfer, you pay your bills online, you receive payment from your customers online. You might receive your payroll direct deposit. Yeah, nice and easy. That's all electronic funds transfer. Payroll, rent, utilities, insurance, interest payments, typically always done online. We call these online payments electronic funds transfers. Easy peasy. Helps reduce cash on hand. Mobile banking. I don't know about y'all, but I have my bank app on my phone. I'm able to see everything right then and there. Makes life easy. You can do mobile deposits. Take a picture of the check, right? Deposit right away. You don't even have to go down to the bank no more. Mobile payments, Zelle, etc. Yeah, everything's done mobilely these days. Makes life a lot easier. This is an example of a bank statement. Hopefully, you've seen one of these before. All right. Bank statement is going to show you everything that happened throughout the month, the withdrawals, the deposits, whether it was cash, a check. The only thing this will not show you, actually, what this will also show you is if you have a check that is outstanding, meaning you wrote the check but it hasn't been cashed yet, it'll be there. All right. Bank reconciliations. At the end of every single month, I need to match what's in my accounting information system cash balance. I need to match that to my bank account. And usually there's a difference. The difference is typically a result of a bank fee, a bank error, a non-sufficient fund fee, outstanding checks that haven't been cashed yet, etc. These are reasons why uh, we need to reconcile our account at the end of the month because we typically don't know about these things until we look at our bank statement. So what I need to do is I go to my accounting information system. I'm going to add in any interest that we earned and unrecorded checks from our customers. I'm going to subtract out any bank fees or non-sufficient funds checks that have bounced, and then I'm going to add or subtract any errors that we have. On the bank side, I'm going to add in deposits that are in transit, subtract out any outstanding checks, and add or subtract the bank errors. And what this does is after that, what's in my accounting information system should match what's in my bank account for a balance for cash. And this slide, I like this one a lot because it tells you everything I just said in a nice, easy way. Bank balance for the bank, plus deposits in transit, minus outstanding checks, plus or minus errors, gives you adjusted cash balance. And then on your accounting side, in your book, cash balance plus collections and interest minus bank fees, non-sufficient fund checks, plus or minus errors equals adjusted cash balance. Now, as long as those two amounts balance, you're in good shape. That is your bank reconciliation. And the way that we do that is in 4 steps. So the first step, identify your balances for your bank statement. Second step, add in any outstanding checks. Third step, subtract out outstanding checks that haven't cleared yet. And number 4, they'll give you your adjusted bank balance. The fifth step is on the book side. Look at your book balance. This is your accounting information system book. This is your cash balance in your accounting information system. Step 6, add in any interest we earned or uncollected accounts that we received from our customers. Step 7, subtract out any bank charges or non-sufficient fund charges. And step 8, you should have your adjusted book balance, and that should match your adjusted bank balance. That's the process. And to make those adjustments, we make adjusting entries. To record a note collected by the bank, debit cash, credit notes receivable. Interest earned, debit cash, credit interest revenue. Check expense, this is a bank charge. Debit miscellaneous expense or bank charge expense, and credit cash. Non-sufficient funds, debit the customer's account receivable whose check bounced, and credit cash. You charge that customer, recover that check that bounced from the customer. All right. Those are the entries. Now, one thing that you should know is this ratio called days sales uncollected. Days sales uncollected, really important because it measures how quickly the company is converting our accounts receivable into cash, how many days it takes to collect cash from the customers, right, for their account receivable. Really important to know. To calculate this, it's simple. We take the accounts receivable balance divided by total sales. And then we multiply that by 365 days. Easy peasy. We want this number to be relatively low, ideally. All right. And then lastly, just some information to be aware of. I mentioned the process that I use called a voucher system. You want to make sure everything matches up together before you start paying some checks out. Receive and report matches the invoice, matches the purchase order, matches the purchase requisition. All that stuff should match before you go paying that check out. Then once everything matches, we want to do what we call an invoice approval. This is authorization from the accounting department to pay the bill. Invoice approval. When everything matches up together, we call it a voucher system. And now, once you've got your purchase order, packing slip, invoice approval, you printed out the check got signed, you mailed the check out, you kept the remittance, stapled it all together, put it in your record, and therefore, if you ever get audited, you're good. That's the voucher system. We use that at the hotel, in the hotel business all the time. All right. Any questions, comments, or concerns? We good? All right. I haven't been talking to myself, right? Y'all here? Okay. All right, good people.
Yeah, we here.
All right. That's what I like to hear. Okay. All right. So just as a reminder, you have 2 action items that you must complete by Sunday night. The midterm exam cannot be completed late. It is due on Sunday. Thanks for asking, Star. Midterm exam is due on Sunday. So, Chapter 8 quiz and the midterm exam both due this Sunday night. You cannot and will not be late with that midterm exam. If you are late with that midterm exam, it will not be graded or accepted, and that will result in a failure for the course. So, to repeat myself very clearly, you will complete that midterm exam due this Sunday night. I want you to complete the Chapter 8 quiz before you take that midterm exam, but they're both due this Sunday night. And to answer your question, Star, yes, the exam is open and available to you now. So if you feel like you're ready, go ahead and knock it out. I did mention earlier that either tonight or tomorrow morning, I will be posting this recording and a recording that reviews the midterm exam. So please be on the lookout for those, and those should help you with both the exam and, of course, the quiz for this week.
Mr. B.
Yes.
Hi, it's Courtney. I hear everything. I'm acknowledging. Do the quiz before the exam and then do
Yeah.
everything before Sunday. I have to hang up though, so I just
No,
want to
you're
make sure
good.
I'm accounted for.
Okay. Perfect. Sounds good.
Okay, thank you. See
Okay.
you guys
You're
later.
welcome.
All right.
All right. With that, I will end it here. Thank you all again so very much for your time today. I really do appreciate all of you, and I look forward to your success on that midterm and, of course, for the rest of the semester. Thank you all so much. Have a
Thank
good
you,
one.
Professor.
Thank-